What is going on, everybody? This is Prepper Princess. I am getting ready to take a trip to Northern California. I'll be visiting with my family, but I'll also be making a stop at my personal financial advisor's office. I've been with him for a long time. He knows my net worth, and I just want you guys to know that despite seeing all these fanatical gurus on YouTube showing how they made their millions in extremely risky real estate investments, Bitcoin investments, Ethereum, dogecoin, Shih Tzu, whatever those coins are, despite them claiming that they have made millions of dollars, and they very well may have. It's possible that they did this through extremely risky investments and just happen to come out on the right side of the coin. But the majority of investors and millionaires make their millions by consistently investing over time. And I think that it is very important that you find a fiduciary financial advisor. And fortunately, I was able to set aside some time with him to talk about why it's important to pick a fiduciary over a regular financial advisor, and also how you can create a tactical portfolio and why that might be super important to you. Because everybody always has fears of investing, fears of losing their money, and of course there are no guarantees, but you do have a way to mitigate your risk and make it less than it would be normally. And you can do this through a financial advisor. So I hope that you find this interesting. Please stick through. Don't be afraid to invest. I want you to invest. I want you to be wealthy. I want you to be happy and prosperous, and I want you to leave a legacy to your loved ones. So let's get to it. But first, this video is brought to you in part by me. I am the author of Living on Almost Nothing, which you can purchase on Amazon. I will leave a link in the description below. What is going on, everybody? This is Prepper Princess, and I am sitting here with Joseph Laswell from Way Financial, my personal financial advisor. How's it going, Joseph?
Hi, everyone.
Hi. So you can confirm that I am, in fact, a millionaire.
I can confirm.
He can confirm. So you are a fiduciary, and I just wanted to go over a couple of questions real quick. Something that is always on people's minds about investing. A lot of people are afraid of investing, and they sort of get stuck and don't really know what to do. So you are a fiduciary, which is really important. Can you explain to everybody what exactly a fiduciary is?
Yeah, you bet, Amber. Thank you. Fiduciary is a professional who legally has to serve your best interest. So legally we serve our client's best interest, and whatever that means under our guidance, our fee-based investment advice. We collect information from you, what's important to you, what your short-term and long-term financial goals are, what your risk tolerance is, and when we understand that general framework, we know what might be, an appropriate investment strategy.
So you develop a strategy based on the preference of what your client wants.
Absolutely.
And then if somebody were to go to somebody who was not a fiduciary, they would go into a bank like Wells Fargo, US Bank, they'd talk to a financial advisor, and what would be different with what they would get from them and what they would get from you, a fiduciary?
Yeah, great question. The industry is made up of two different types of financial advisors. So you have commission-based financial advisor, you have a fee-based financial advisor. Now, majority of the industry is made up of commission-based advisors, approximately 70% plus or minus a little bit there, but similar to how a real estate agent gets paid when you buy or sell a property. That real estate agent makes a fee for that, and in the same way, a commission-based financial advisor would also get a fee for whatever investment recommendations that they gave you. For example, they show you a mutual fund with a good track record, and they say, hey, I think this is a suitable investment for you, and you agree. That mutual fund typically on the front end has something called a front load, and all of this is public record. You can look this up. Google knows pretty much everything. So look up the symbol of your current mutual fund, and it will say if it has a front load on there or not.
Yeah. And for a lot of people watching, they actually don't even know what a mutual fund is, but that's totally okay. So if you were to go to a bank and get somebody, they would get a commission on the front end, meaning that they make all of their money as soon as you sign up for their services. Where you're different, you get paid, a certain percentage on a yearly basis, but all of the investments are based on what your client wants and what is best for them.
Yeah, so the model working with the fee-based advisor is, I get paid an assets under management fee, right? So whatever your total investment balance is, I would get a percentage of that on an annual basis, and then I get paid 1/12 of that monthly. Some advisors get paid quarterly, that's also common. But I don't get any upfront money, no commission, so to speak. But then I have to provide ongoing value.
Ongoing, that's very important.
I think that's the key.
Yeah, so every time I email Joseph or I give him a call, there's always open communication between the both of us. And I think that that's really good.
I think one of the things I hear the most with new prospective clients coming into the office, and I ask them, well, what's going on with your current advisor? Why are you looking for potentially a new investment advisor? And I hear that, I never hear from my person.
Lack of communication.
Yeah, maybe I get an email once a year, but lack of communication is probably the most consistent. And I would say that is fairly normal. Unfortunately, working with a commission-based advisor is that advisor spending his time looking for new prospective clients to
make his commission,
make another commission.
And I can tell you, I've been with Joseph for a while, and I get at least a weekly update. And then if I have any questions, he always responds to my questions. So I did have one other quick question. Well, it's not really a quick question, but a very important question. So I have because I came to you with my plan, and my plan was a tactical portfolio, taking less risk but making more reward over the long term. So I have with you what I call a tactical portfolio. I think you call it that too.
Yeah, that's correct.
Right. So why would somebody want to choose a tactical portfolio over a standard growth or regular portfolio?
Yeah. As a consumer, you have a couple different options here. You can choose a tactical or active portfolio management style, or the alternative to that is passive. Day trading is also another one, but that's more unusual or less common. Day trading, certainly higher risk. But passive is the alternative to tactical. Most passive strategies are seen in your 401k, even that target date fund that you have. A quick example is the investments that you hold in your current portfolio right now were the same investments that you were holding 12 months earlier. That is going to be your passive strategy. And over 10, 20, 30 years, passive strategies have shown to be effective. You've seen the jagged charts where they start low and end up high, and that's just historical of the market. However, a tactical platform is the one we prefer, and we see this at the highest institutional level, the endowment fund, the pension fund level. We see tactical money managers, meaning active management. Active money manager is going to be looking at various analytics, various leading indicators. They're going to have a proprietary algorithm that's going to share with them what part of the economic cycle that we're in. And as you all know, economic news can happen quickly, right? Just coming out of this global health pandemic, that was, a massive stock market correction.
And just last week, yeah.
And even last week with this new Omicron variant and potential interest rate hikes and the federal budget, these things can cause a quick market sell-offs. And so, the analogy we often use is if it's raining outside, you don't go outside in a t-shirt. Well, you would adjust and put a jacket on or grab an umbrella. Or if it was 100 degrees outside, you probably wouldn't wear a big jacket, big snow parka, for example. And as economic conditions change, so should the proper allocations towards your various asset classes, sectors. Historically, certain asset classes are going to do better than others. And And so our active money managers are going to make those what we call scene changes in an effort to bring risk down. Really, if we can prevent loss to your portfolio, in some examples, that's just as good as making money. If we're not having to have major recoveries to the portfolio because of major losses, right. We're actually further ahead in a strategy, and so we can illustrate that, model that out. Quick example, Amber, I use this multiple times a week. If you had $100,000 and you lost 50% of your portfolio, how much money do you have?
$50,000.
$50,000. So now that you have $50,000, what percent return do you need to get back to $100,000? It's always a trick question, putting Amber on the spot, but you need 100% return from that $50,000 balance just to get back to $100,000. So you lost 50%, but you need 100% to get back to where you were. That's a great example of risk mitigation toward protecting your portfolio against major losses is a big part of our tactical strategy.
Yeah, and that's awesome. And we were talking earlier about how when the market is good, you can throw a dart at pretty much any stock and it's going to go up. But when the market is bad, that's when you know that you may have made a mistake in not providing yourself with a tactical option.
You know, like the Robinhood platform has just blown up over the last few years, and a lot of younger do-it-yourself type investors, and I think that's fascinating. I'm also one of those Robinhood fans because it's just so easy to buy and sell positions, and like Amber says, when the market's going up, you feel like a hero, but all of a sudden that volatility comes around or the market sells off, and you're just not so confident anymore that that was the right strategy. Right. So, we don't try to pretend that we know how to be a professional investor. We let the true professionals do that. And as individual consumers, it just is nice to know that I have some of the top portfolio managers available in the country looking at our client accounts and portfolios and making those adjustments that are necessary.
Awesome. Thank you so much. Well, I just wanted to ask these couple of questions. I know this is on everybody's mind. If you have more questions, you can go ahead and leave them in the comment section. Next time I'm in Ripon, California, I'll be visiting with Joseph again, and I can ask him in person. Otherwise, you can contact him, and I will leave his contact information in the description below. Thank you so much for your time, Joseph. Here it is.